Good day, everyone. Welcome to today's session where we'll dive into a crucial aspect of financial decision making that goes far beyond simply documenting past performance, management accounting. This specialized branch of accounting is distinct from financial accounting, which primarily caters to external stakeholders and compliance requirements. Management accounting, on the other hand, equips managers with forward-looking insights and actionable data to plan, control, and make informed business decisions that drive growth and efficiency. Today, we'll explore the core functions of management accounting and uncover how they serve as powerful tools for fostering strategic business performance. Let's break this down step by step. 1. Planning and budgeting, OPEX versus CAPEX. The cornerstone of management accounting lies in planning and budgeting, essential processes that guide businesses in charting their future course and optimizing resource utilization. Every organization, whether large or small, needs a clear roadmap to achieve its goals, and budgeting serves as a financial blueprint that aligns operational activities with strategic objectives. A critical aspect of budgeting is understanding the distinction between two types of expenditures: operating expenditures, OPEX. These represent the routine, day-to-day expenses required to sustain business operations. Examples include employee salaries, rent, utilities, marketing costs, and the procurement of raw materials. OPEX directly impacts the income statement and reflects the immediate costs of running the business. Capital expenditures, CAPEX. Unlike OPEX, CAPEX involves investments in long-term assets such as purchasing machinery, upgrading technology systems, or constructing new facilities. These expenditures are capitalized, meaning their cost is spread over time through depreciation as they contribute to the company's future earning potential. Understanding this distinction is vital for effective budgeting. For instance, while OPEX decisions may focus on cost control in the short term, CAPEX decisions require a more strategic outlook, balancing upfront investment with long-term benefits. Through budgeting, managers can forecast revenue streams and anticipate expenses, identify areas for cost optimization and eliminate wasteful spending, ensure departmental activities align with overarching company goals. Management accountants play a pivotal role in preparing detailed budgets and forecasts, enabling decision makers to allocate resources wisely, even when time and cost constraints are tight. Those two. Cost analysis, CVP, ABC, target. Costing. Cost analysis is another key function of management accounting, providing the foundation for pricing strategies, operational decisions, and overall cost control. Let's explore three essential tools that help managers navigate these challenges. A. CVP analysis, cost volume profit analysis. This tool helps managers understand the interplay between costs, sales volume, and profitability. It answers critical questions like: how many units must we sell to break even? What happens to profit if we adjust pricing, reduce fixed costs, or scale production? For example, imagine your fixed costs are RM50,000. The selling price per unit is RM25 and the variable cost per unit is RM10. Using CVP analysis, you can calculate the break-even point as follows: RM50,000, RM25, RM10, at the 3,333 units. This means you need to sell 3,330 units just to cover your costs. Armed with this insight, managers can make smarter decisions about production levels, pricing strategies, and marketing efforts. ABC, activity-based costing. Traditional costing methods often allocate overhead based on production volume, which can lead to inaccurate cost estimates. Activity-based costing, ABC, however, allocates costs based on the actual activities that consume resources. For instance, if product A requires twice as much machine setup time as product B, ABC ensures that product A absorbs a larger share of the setup cost. By offering more precise product costing, ABC becomes particularly valuable in competitive markets where accurate pricing can make or break profitability. C. Target costing. Unlike traditional costing, target costing begins with the market-driven price at which a product is expected to sell. From there, it works backward to determine the allowable cost of production. If the estimated production cost exceeds the target cost, managers must find innovative ways to redesign or streamline processes to meet the target. This method is widely used in industries like manufacturing, automotive, and technology, where cost efficiency and competitive pricing are critical. By leveraging these tools, managers can effectively manage profit margins, stay ahead in competitive markets, and eliminate inefficiencies, all while making informed decisions about product design, pricing, and resource allocation. So 3. Variance analysis and performance. Measurement variance analysis is the process of comparing actual performance against budgeted figures and investigating the reasons behind any deviations. This allows managers to identify issues early and take corrective action before they escalate into larger problems. For example, imagine your budgeted monthly sales were Rm 100,000 pounds, but actual sales amounted to Rm 85,000 pounds, a negative variance of Rm 15,000 pounds. To address this, you would need to ask questions such as, was the variance caused by weaker than expected demand? Were marketing efforts insufficient or misaligned? Did supply chain disruptions limit product availability? By analyzing variances, managers can pinpoint the root causes of performance gaps and implement targeted solutions. Common types of variances include sales variance, differences between forecasted and actual revenue, material price and usage variance, deviations in raw material costs or consumption, labor rate and efficiency variance, discrepancies in wage rates or worker productivity, overhead spending and volume variance, variations in fixed and variable overhead costs. In addition to variance analysis, managers rely on key performance indicators, KPIs, to measure success. These metrics, such as cost per unit, operating margin, and return on investment (ROI), provide a clear snapshot of business performance and help align employee efforts with organizational goals, especially when tied to incentive systems. Flexible budgeting and rolling forecasts. In today's fast-paced business environment, traditional fixed budgets often fall short in adapting to unexpected changes. That's where flexible budgeting and rolling forecasts come into play. A. Flexible budgeting. Flexible budgets adjust based on actual activity levels, offering a more realistic comparison between projected and actual results. For instance, if your original budget assumed production of 10,000 units but actual output was 8,000 units, a flexible budget recalculates expenses to match the lower production level. This approach is especially useful in industries with fluctuating demand, such as hospitality, manufacturing, or logistics. B. Rolling forecasts. Unlike static annual budgets, rolling forecasts are updated regularly, monthly or quarterly, to reflect changing market conditions. This dynamic approach allows businesses to adapt quickly to shifts in customer demand or industry trends, reallocate resources to seize emerging opportunities or mitigate risks, maintain agility in volatile environments, Rolling forecasts empower organizations to transition from reactive planning to proactive strategy, ensuring they stay ahead of the curve in an ever-changing marketplace. Conclusion: to sum up, management accounting is an invaluable tool that transforms raw data into actionable insights, enabling managers to lead their teams, optimize operations, and achieve strategic goals with confidence. Let's recap the core functions. Planning and budgeting provide a financial roadmap for allocating resources between short-term OPEX and long-term CAPEX. Cost analysis tools like CVP, ABC, and target costing enable better pricing, margin management, and operational efficiency. Variance analysis and KPIs ensure accountability and performance monitoring. Flexible budgeting and rolling forecasts keep businesses agile and responsive in dynamic environments. By leveraging these principles, management accounting empowers decision makers to navigate complexity, drive innovation, and deliver sustainable business success. Thank you for your attention. In our next session, we'll delve deeper into how accounting and finance principles shape investment, evaluation, and influence high-level financial decision-making. See you next class.